will central banks like the Federal Reserve step in, save the bond market, and whip inflation to the ground? Well, the Fed can do no such thing because it is a market follower rather than a market leader. And nothing makes that case more powerfully than looking at some charts. So let's do that. Let's begin by looking at a classic chart from EWI. Here we have two data series. The continuous line is the yield on 3-month Treasury bills. This is a rate that is set on the open market. And the dotted line is the Federal Reserve's federal funds rate. When you hear that the Fed has raised or lowered interest rates, this is the rate that people are talking about. And one thing to notice right away is that these two rates trend quite closely together. But if you study the chart, what you'll find is that the market rates change trend before the Fed does. So for example, in November of 2000, market rates began to fall. And in January of 2001, the Fed followed suit and began cutting rates. And they cut rates all the way down with the market. Market rates began rising in June 2003. The Fed again followed in June 2004 and raised rates along with the market. Now, in February 2007, the market rates began to fall. And by late August, the disparity between the market rate and the Fed funds rate was so severe that the Elliott Wave financial forecast observed in real time that the Fed was soon to follow. And if we look at what happened next, just a few weeks later, the Fed followed indeed and began cutting rates. So the Fed follows the market. It does not lead. And this is some history from 2000 to 2012. Well, let's look at some more recent history. This time the dotted line is the Fed funds effective rate, and the solid line, the continuous line, once again is the yield on 3-month Treasury bills. And we see a similar phenomenon here. Heading into the beginning of the year, the Fed funds rate and the market rate were both relatively flat, but the Treasury bill yield began accelerating higher and higher, and it was only after that, in March, when the Fed announced that it would raise the federal funds rate. And we've seen this in recent times, but even if we go all the way back to the 1980s, when interest rates were quite high and the Fed got credit for whipping inflation, were they doing something different from what they're doing now? No, it's exactly the same pattern. Here we've got the Treasury bill rate again, the continuous line, the dotted line, the Fed funds rate. And if you look at these changes in trend, what you'll find is that the Fed changes its trend coincident with or after the trend in the market. The Fed does not lead. And by the way, we're looking at data from the US, but we could also look at data from other countries. This is the 3-month UK government bond rate, showing that that rate has led the Bank of England's official bank rate for over 2 decades. This is a chart from the socioeconomic theory of finance. And we found the same thing when we looked at data in Australia. This is a chart from my colleague Mark Galashevsky looking at the actions of the Australian central bank versus a market set rate. And the same phenomenon holds there. The Fed follows the market. It does not lead. Now, let's consider a related question, which is no matter whether the Fed can lead or follow the market, do interest rates tell us something useful about the probable trajectory of stock prices? Conventional wisdom is that they should. The conventional wisdom is that stocks and bonds compete for investors' capital, and so the higher yields get on bonds, the more attractive those bonds should be relative to stocks. And the opposite is true. The lower the yields get, the more attractive stocks should be. So we would expect, according to conventional wisdom, stocks and bonds to trend in opposite directions. Stock prices and bond yields to trend inversely to one another. And there's some evidence to support that. We'll look at a series of charts from the socioeconomic theory of finance. For example, there was the period from July of 1984 through mid-1987 where stocks roughly doubled while the federal funds rate got cut nearly in half. And there have also been times when stocks have fallen as rates have risen. For example, the classic case is January 1973 to October 1974. As the stock market was plummeting, rates were trending higher and higher. So based on conventional wisdom and based on the history that we have just reviewed, imagine that I told you that interest rates would net rise for 24 years, nearly a quarter century. Would you short the market? Would you expect that stock prices would fall as a result of that? Well, if you took that bet and acted in that way, you would have shorted the market in March of 1942 and missed out on a roaring bull market in stocks that lasted essentially the entire time. It's the bottom panel in this chart here. Interest rates net rose, and the stock market net rose right along with it. 24-year period that deviated from the conventional view of stocks and interest rates. And by the way, there have also been times when stocks have fallen and rates have fallen concurrently, including 4 of the largest bear markets on record. So even if you know ahead of time what's going to happen in interest rates, it is not a helpful guide to help you anticipate what's going to happen in the market. And the bottom panel on this chart is the action in the Dow Jones Industrial Average during the global financial crisis. From its high in October 2007 to the low in 2009, the authorities cut rates essentially to zero. And in hindsight, the Fed, and a lot of people's minds, they ended up getting credit for stopping the financial crisis by cutting rates to zero. But let's keep 2 things in mind. One, all of these rate cuts did not stop the greatest fall in the market since the Great Depression. And if you look at the interventions of the Fed in Congress during that decline, what you find is that the market continued lower, often accelerating lower after each of the significant interventions. This is another chart from the socioeconomic theory of finance. So if you were to ascribe a cause to these government interventions and these central bank interventions, you would have to conclude that the interventions made the market go down. So what's going on here? Are these government interventions really making the market go down or really making the market go up? Well, in socioeconomics, we have another way of looking at it. The conventional view in economics is that the Fed is an actor exogenous to the market, an actor outside the market that acts on it and can regulate market prices. Well, in socioeconomics, we understand that the Fed is not separate from the herd. It's a part of the herd. It's subject to the same waves of optimism and pessimism as everyone else. And so when traders panic and send prices lower in the stock market, well, the Fed panics, Congress panics as well, and they engage in all kinds of interventions. They're just expressing that negative social mood right along with the traders. And as for the Fed's role in regulating the economy, as we've seen, the Fed is in fact at the mercy of the economy. They're at the mercy of trends in the market because they are a market participant just like the rest of us.